Hey guys, welcome to an all new video. This is basic investment terms, and today we're going to be talking about the moving average. Now, the moving average, there are a lot of types of moving average. There's the simple moving average and there's the exponential moving average. Now, it's called the moving average because it's the average of the latest closing prices of a certain stock. And you can use a lot of different types of moving averages. You can say, I want the 5-day moving average, I want the 50-day moving average, or I want the 200-day moving average, let's say. Okay, so let's say we take the 5-day moving average. Then that means you take the last 5 days of trading days and you take the closing price of that certain of that said stock and you average them out. And so when you add a new trading day, well, you add a new value, but you need to take the first one out. So you only keep 5 days. That's the moving average because it moves along as the trading days are added. And you always get a reflection of, if you use the 5-day moving average, you always get a reflection of the last 5 days, including this current day that you're using. So, the exponential moving average is pretty much the same thing, except you put a lot more emphasis on the more recent values, so it's not proportionately added to the average, but it's disproportionately represents more recent closing prices in the stock. So you get more fluctuations, you get more variations, you get some more inflection points. So you get a nervous chart, if you will. So you get a more accurate and quickly reflective chart of what is going on in a more current setting. So I've put here a little graphic, a few price per shares. Let's say these are closing prices. So 10, 10, 11, 12, etc., etc., etc. And so you just move along like that. So let's say we want to use a 5-day trading, a 5-day moving average. So you need to start on the day number 5 because you need to have at least 5 trading day values. Okay, so the first value here, that's what the 5-day moving average could look like. I've put a little graph here with the little dotted line to represent the 5-day moving average. So you see here as the closing days added on, the 5-day moving average changes in proportion to what the closing price that is added is, and in proportion to what the closing price of the data that is withdrawn was. All right, so if the closing price increases, the 5-day moving average will have a tendency to increase, but will always lag behind what the current closing price is. Like I said, this is a retrospective trading metric. All right. So this is used for a few things, mostly for traders, but you can use this as a marker of support or a marker of resistance for a certain stock when you're trading or when you're investing into it. So it's used as a metric that sort of smooths out all the trading curves. So if you use a longer metric, such as the 200-day moving average, then it's going to layer out the last 200 days, and it's going to cushion out all these little inflection points and all these little spikes and drops and all of that. It's going to average all of these out, and you're going to get a much more smooth value to use as a benchmark for your trading or your investing. So I'm going to keep this video short, guys. I just wanted to show you a little bit about what the moving average was, so you get a little bit so you guys have a clue when you encounter this metric and you know how to use it in the future. So I hope you enjoyed this video. If you did, don't forget to leave a comment, leave a thumbs up. Don't forget to subscribe for any upcoming videos. Thanks, guys.